We have a huge footprint in Canada. For a company with such a huge footprint, we only employ about 270 people. So in BC, there's only 5 of us account managers that look after the whole of BC. And then we have a regional vice president who kind of like overlooks the whole province. And we have a guy called Ian, who you want to make friends with. He is the regional risk manager. So he's the guy that says yay or nay on whether we insure a property in BC. All right, so that's the day you want to call and you want to buy some beers. All right. So he's actually working really, really hard right now to take out a lot of these properties that we weren't previously insuring, just because business has kind of changed for us in 2018, 2019. Properties have gone up in price, so really single family isn't kind of like where we are nowadays. It's more like the strata properties, and those are the properties that we had a lot of issues with in the past. So we are re-looking at all these buildings and basically making them insurable again. Okay.
What were your major sticking point issues?
So it was kind of like depreciation reports, negative cash flow in their strata financials and stuff like that.
Do you find
or
that
special assessments.
Like in the majority of places?
Majority of the places in Vancouver, yeah.
Wow.
Not good,
Jeez.
Not
generally?
good. Yeah.
And age restricted as well?
We're okay with age restricted.
Oh, okay.
CMHC isn't.
Okay, yeah.
The more responsible they get.
Yeah, we're okay with age. That's a good differentiator right there.
Yeah.
And mobile homes, CMHC doesn't do mobile homes either. Okay. So we're pretty condo friendly nowadays. The way we look at it really is we look at the client's financial situation. So if there is a special assessment and we feel that the client can manage that kind of extra stress, we will be okay to insure that property.
How do you judge what the special assessment might be?
That's Ian's job.
5,000 or
He's got
40,000.
that's what he does. He's buried in paperwork all day just looking at these things. So he's got all the reports.
Depreciation reports?
Yeah.
How the hell do you make heads or tails whether they're legit or not? Eh?
Yeah. I don't know how he makes sense of tails of it, but he does a great job at it. Trust me. And I'll be more than happy to bring him out with me one day and explain that kind of
Is
stuff.
that the guy you call
Yeah.
Ian?
Yeah.
Is he really, his name is Ian, or you just call him?
Oh, it's a real guy.
Real identity.
All right. So that's kind of what we are, guys. If you guys haven't seen our website, Genworth.ca, can everyone see that?
Yeah.
You guys okay with that?
Yeah.
So our website is pretty user-friendly for brokers and realtors alike. Okay. If you go to Genworth.ca, you go to that Realtors tab there. I would suggest that you guys maybe bookmark that on your computers because there's a lot of useful information in that. We'll go over some of that information as I progress here. Okay. Let's talk a little bit about how mortgage insurance works, and then we'll talk a little bit about where Genworth fits in. And then what I'll do is I'll touch on some products that we have that are unique to the other insurers out there. And then we'll talk about the homeowner assistance program as well. That's a pretty unique program that Genworth has as well. I'll give you some stories on that, okay? I do have a short video here on what mortgage insurance is, but I think everybody's familiar with that, so I'm going to skip that video. Alright, save you guys some time here.
No entertainment value?
Right, yeah, right. So this is kind of like what a house buying process looks like. All right, so you have a client looking to buy a house. The first thing I guess you guys do is make sure that your client is pre-approved for a mortgage, right?
Send Chad over.
Right, send Chad over. So that's kind of like where Chad comes in. He qualifies the client up to a limit. I like to use the famous analogy. There's no point hanging around in a Ferrari dealership if your budget says Chevy.
Yeah.
And there's nothing wrong with Chevys. Chevy. All right. So Chad qualifies the client then comes to you, tells you what that qualification looks like. You find him a home based on that qualification. Once we have an offer to purchase, the offer to purchase is accepted. That offer goes back to Chad. Chad then finds a lender, or he's already found a lender. He sends that back to the lender to get a final approval on that file. If that file is coming in with a down payment of more than 20%, that final approval from the lender is all that Chad needs to basically remove subjects, okay? If the down payment on that file is less than 20%, which means it's a high ratio file, which means it needs to be insured, then that lender would send that file to one of the insurers, okay? And we hope that that insurer would be Genworth.
What would you say the percentage is from a lender approval to get, so the lender approves it, but you guys decline?
So the lender will already know whether or not we
Yeah.
will approve or decline.
Yeah.
So if a lender's approved it, unless there's something drastically wrong with
Yeah.
that property, right? Because it's generally the property,
Yeah.
right? Because they would know the covenant, they would know the lender,
Mhm.
so they would know that the client is okay.
Yeah.
I'd say maybe like 1 out of 10,
Okay.
right?
So once the lender approves, it's
Pretty much.
pretty much, okay.
Yeah, the lender will reach out to us beforehand as well.
Yeah.
And let us know this is the kind of file that we're looking at, and they would know the policies too, right, of what we'd expect that file to look like for an approval. So once your lender sends it to us, we approve that file or we decline that file. If we decline that file is declined. Okay, your lender has an option to send it to another insurer if their policies are different. But because this industry is so regulated, all our policies gonna look the same. Okay, there's just a few things we can do a little bit differently than what CMHC and Canada Guarantee can do. But other than that, all the policies are pretty similar. Okay.
When you said the Canada Guarantee was getting more aggressive, what are they doing?
They just have more presence in the market, so they're doing a lot more of these seminars and sponsoring a lot of golf events. So I guess they have lots of money to throw around, right? Once we approve that file, we send the approval back to your lender. Your lender then sends all the paperwork to your notary closes the deal, and everybody gets paid, and we move on to the next one, right? So that's kind of like what it looks like. I'm sure you guys already know that, right? So I just wanted to like highlight where Genworth fits in. So on a high ratio file, it's very important that your client has a subject to finance, okay? Because we might like that client, we might not like the property that it's buying. Okay, so I've had a lot of situations where, you know, lenders said, you know, the client's great, so realtors got in with a subject-free offer, and then we've turned around and said, hey, we don't like this property. And then all the insurers have said, we don't like this property. So now that client needs to find that extra money to bring it up to a conventional mortgage, so that the lender can do it without an insurer.
So what would make it an unlikable property? Or are you gonna get to that?
No, we talked a little bit about that, but
Sure.
it could be anything, right? It could be, you know, the valuation could be off. It could be, if it's a startup property, there could be a special assessment on that. There could be a negative in the strata financials. You know, it could be an ex-grow-up that hasn't been remediated. Could be anything really, right?
What about, sorry,
Shallow wells, for example.
Yeah, shallow wells, it could be like ALR land or something, right? Yeah.
Difficulty with insurance.
Yeah.
Yeah.
Basically, the rule of thumb is, we will only take on a property that's readily marketable. Okay, so if we ever end up with that property, we want to be able to sell that property, right? So you might have this fantastic home in the middle of the ocean with $500,000, and it's brand new, but that's not a readily marketable home, right? We can't find a buyer for that just like that. So we probably wouldn't insure something like that. So we had one the other day, actually. I think it might have been, I think it was a First National file, and the property purchase was like $550,000. It was a brand new 12,000 square foot house in the middle of Saskatchewan somewhere, on like acres and acres of land. And we declined the file because it wasn't a readily marketable property. We couldn't,
Hi, how you doing?
good, how are you? We couldn't sell that property if we ever ended up with it, right?
so it's like a farm
Yeah,
in the middle of nowhere.
yeah.
What about square footage of the property?
We're okay with the square footage as long as it's not like these micro homes that are popping up nowadays. We're not okay with those.
Okay.
Back to the readily market, I guess we're still on that.
Yeah.
Gulf Islands, they're harder to finance over there?
There's nowhere that we would not consider insuring. So if you have a property, the best thing to do is if you have a client who's looking at a property that is kind of like in a rural setting on a unique kind of a location, best thing to do is reach out to me and give me the address, and I'll phone Ian, he's a real guy. I'll phone Ian,
The really.
the real Ian, and he will tell me whether or not we will entertain that property or not. Alright, so I'll leave my business cards with you guys, so, you know, if you ever have a situation, call Chad, and Chad can contact me directly. and we could get that figured out for you guys.
Sure.
All right? Any other questions, Ace? Cool. So let's look at what's been happening in the last 10 years in mortgages here in Canada. So we've had about 7 rounds of housing rule changes since 2008. So in the last 10 years, the rules have changed about 7 times.
A couple times.
Right? So just a few times,
Just a few
right?
small changes.
Right, so you know, back in the day, like in 2008, we used to have a 35-year amortization on a high ratio file, right? You know, we used to do interest-only mortgages, minimum down payments were like 5%, and then things changed when we like started getting rid of a lot of the stuff. Those are the golden years, right? 2008 to about 2011 maybe, 2012.
Golden years.
Golden
I
years,
like
right? Right? I was a broker then, and it was great, right? You know, I used to do files with no documents, right? We made a lot of changes, right? So the 35-year RAM came down to 30-year. You know, we could still refi up to 85%, and then we got rid of the insured HELOC, so you could do like a line of credit against your property that's insured. We then got rid of the 30-year RAM, brought it up to 25 years. Then we got rid of the refis. So basically, if you have a client who's got a high ratio mortgage, he cannot refinance that property. He cannot refinance that mortgage. Okay, so that mortgage needs to be conventional for him to refinance. So that was a huge change, right? So, and then, you know, the insured mortgages brought in a stress test in 2016, and then that stress test was rolled out into all mortgages in 2018, and that's kind of like where things kind of went down a little bit, right? Have you all been realtors for a while? So did you see the impact of these changes?
Oh, yeah.
A lot?
Sure did.
When would you say the biggest impact was? When did you realize there's things are really going south here?
Well, 08 was the biggest kind of crash.
And then I guess the
91, the war in Iraq.
yeah. But I think the biggest one was the stress test on the
Oh, yeah,
conventional
yeah.
Because
mortgages.
it hurt
right? So-
affordability so
yeah.
much, right?
It did, right? So Chad and I were talking.
Yeah,
earlier on.
20%
Yeah.
lesser qualification.
Exactly. You know, before that, an A client looked like a certain kind of like you know, fit in a certain profile. All of a sudden this year, that A client is the B client, right? So there's a little bit of you know, an issue with affordability right now. So we will talk a little bit about that and what we're doing to make that better for you guys. All right. I wanted to show you guys what a Genworth borrower looks like in Langley. So we insure a lot of properties. So what we did, this is for 2018. So we kind of like averaged out all the borrowers we had in Langley in 2018, and this is what we came up with. Okay, so this is again what Ian did. Okay, Ian's a great guy. So
Maybe like here.
yeah. So this is kind of like what your average borrower in high ratio borrower in Langley looks like. Okay, the average income is about $113,000. This is a household income. Okay, so per file income. So normally it's a couple, but sometimes they could be character over there as well. Okay, so incomes are not bad. Average employment tenure is about 6 years, so that's pretty good. People have good jobs and they've been at their jobs for a while. Interesting fact here is about 52% of borrowers are less than 35. Okay, so what that means is when we talk about a high ratio business, when we talk about a high ratio mortgage, first thing that really comes to mind is a first time home buyer, right? Less than 20% down payment, that kind of stuff. But what we see that's not the truth anymore. So a lot of people who are second time or third time buyers are also in the high ratio space. So not everybody out there has a 20% down payment. Okay. 29% GDS is the average. So the GDS, everyone know what a GDS is? Right? Chad, you good?
Yeah.
Okay, so the average GDS is 29. Notice how we didn't put the average TDS out there, because the average TDS is probably the top line, which is 44%. Okay. But the GDS is pretty good, so people are buying homes within their means. Okay. Average mortgage size we saw in Langley was just shy of about $412,000. Okay, so it's kind of like that strata, maybe townhouse kind of a property. Okay. We're writing some good credit, so 92% of our borrowers had a credit score of over 660 beacon. So people have good jobs, they have good credit too. Okay. Our business in Langley 17% of the insured homes were detached. So we're kind of like in that strata space, right? We insure very few single-family homes. Interesting fact of here is about 1 in 4 of the clients received a gift as a down payment. Okay.
Very fun.
And that money has to be, does that have to be in their account for 90 days or something like that, or in their?
No,
parents'
not if
account,
it's a
or-
gift. With
Not
a
if
gift,
it's a
just need a gift letter and you're good to
Oh,
go.
okay,
They just
okay.
have to supply a gift letter and then show the deposit into the client's account, but no history is required on that.
Even if it's a farm?
What's that?
Even if it's
Sure,
coming
need a
from
fin track
overseas?
on those ones though.
I think that depends on the bank.
Yeah, it depends on the lender with
Yeah.
overseas, but
Even less of a concern
yeah.
on it and all that.
Yeah,
But,
exactly.
I was just gonna ask you, a lot of places advertise people check their credit scores online or whatever. Is there anything where it doesn't cost money and they don't affect their ratings by checking in on scores and stuff? Can it
I think that a lot of the
You're
a
like
lot-
that.
Yeah, a lot of the banks are offering like free credit checks now.
Yeah, on their,
Yeah,
on your
online
cell phone,
banking.
right?
I
So
think
you
my
know,
Scotia app
yeah.
has that, and I clicked on
Soft
it, and it's
hit.
like.
I don't know how accurate it is, but it's pretty much there. It's a soft hit too, so it doesn't
Yeah.
actually show up on your credit bureau.
Yeah,
So that's probably a good place to start, right? It might be a little bit different, because a lot of the times what happens is, when a file comes in from a lender, we'll put, there's 2 credit bureaus, right? There's an Equifax and a TransUnion. Lenders normally just pull 1.
Yeah.
We'll pull 2. So a lot of the times, something might be reporting on one, might not be reporting on the other. So we pull both and take an average beacon, right? So I think the best place to start is with those online apps that your clients have, online banking apps. They pretty close to where your beacon should be. All right. So that's an interesting fact there, right? So for someone like Chad, if he's dealing with a client who's kind of doing a refi on a conventional mortgage and pulling equity out of the property, because people have equity in their property value, right? I think prices went up. You guys could probably tell me better. In the last year, what about 40%? Roughly, give or take.
price has
Right.
gone up in the last year, 40%.
Not last year, but the
No.
last
Last year a bit,
5 years.
No,
Yeah.
flat over the last year, down 5%.
about 5%. So people have built up tons of equity. So what's happening nowadays is a lot of people are actually refining and pulling this equity out, giving the money to the kids to put a down payment on a property and get into that strata home, right? So it's a good thing to know that, you know, the parents don't need to like kill themselves and refi their place, pull out 20% to give their kids. There is a way that you can do this with a 5% down payment, right? So you can pull out minimal amounts, all right? Average age of property in Langley that we've been shown is about 19 years, so a lot of people are buying older strata units. Around about that $600,000 mark.
And you're saying, in your opinion, generally, unless they're fairly new, most of these stratas are kind of shoddy situations.
I wouldn't say most, but yeah, a lot of them are, yeah. But,
I just wonder, I mean, you get these young kids, they're getting into possibly not a good situation in the long run.
and that's where we draw the line. If there is a situation
Yeah.
where, you know, the client's gonna be faced with like a $50,000 special assessment in the next year or so,
Yeah.
and, you know, he's just struggled to save 5% to put a down payment on the property, we're gonna say no to that file. Just to save his skin a little bit, right?
Self-managed strategy, I guess you would look at that.
Yeah, right
That's,
away, right
that's the
away.
tough one. So we've had a lot of those. We've kind of been saying no to a lot of those files, the self-managed files. A lot of them are popping up actually, right? So we're saying no to a lot of those. Okay.
Average
Average sales
person-
price, about less than 500.
I was gonna say, average person in strata is about 5 years anyway, so.
Yeah.
You know, get them in early,
Yeah,
get them out. Right.
exactly.
Sell them, upsell them and move on.
Yeah. So the average sales price, I think that sales price there is kind of like a new condo in Langley, correct?
Yeah, yeah.
So that's kind of like where the
Few
business
old
is.
townhouses too.
Right? So that's kind of like what your business in Langley looks like. That's what your clientele in Langley looks like, okay? Just for comparison, I have one for Surrey. It's pretty much similar.
Can we get a copy of these?
Averages.
I can send
Average
it to
is
this
high,
to
right?
Chad.
Yeah, if you send it to me, I'll make sure everyone gets,
Great.
gets a copy and links to the website and everything else.
Thank you.
So it's pretty similar across the board. You know, we have a fewer detached homes in Surrey, just because I guess Surrey prices are a little bit higher than what they should be. Average sales price is about 520. 20 years is the average property age, so people are buying older properties. I'll tell you what, I'll get back to why I keep saying that, okay? It's great information for you guys. Average mortgage size is around about that 450 in this area. Okay, so that's kind of like what $115,000 of income is getting you nowadays, right? You know, back in the day when I was a broker, if I saw an income of $115,000, I would like verbally approve somebody for like $800,000. Not anymore. So that's kind of like the average mortgage that you're getting with $115,000. And then just for interest, I have one for BC here as well. Okay, so across BC, you know, average incomes are about the same. Average sales price is about 455. You know, 30-year as the average property age. But the important things to know is that a lot of the new people that are getting into the property market, they're getting gifts, right? And they're not taking on big mortgages.
I'm surprised the average sale price isn't lower.
Yeah.
If you take into, you know, all the northern communities and where real estate's.
But that, I think bulk of the sales happen down here.
Yeah, I guess, okay, right, yeah, that would,
Especially
yeah,
with
okay,
if you get 20,
yeah, right. That
there's
makes
just
sense.
under
Right, so when you look at
20%.
BC, we're kind of like 50-50 with single family and strata property. So that kind of tells you that, you know, when you ask me a question about whether we insure in a certain area, we'll insure anywhere. As long as we can sell that property, we'll insure it.
Nice.
Interesting that the mortgage average is lower,
Yeah,
and yet the sales average is higher.
yeah. So that kind of tells you that a lot of the northern BC are probably high ratio funds, right? Because no equity there, properties don't grow that much in price. There's no gifts to be had there because, you know, mom and dad can't pull out too much out of their property, right?
Right, yeah,
Right?
yeah, no, it makes sense, yeah.
So everyone's going in with a 5 or 10% down, right? So the minimum down payments required in Canada for a high ratio file is 5% on the first 500,000. Okay, maximum purchase price is $1 million on a high ratio file. So anything over $1 million, your client will need to come up with at least 20%.
So 5 to 500,
Yeah.
and then 5 to a million.
5 to 500 and then 10 to $1 million.
10 to a million.
Yeah.
Is it's an escalating scale, or is it just right after 500, it's 10% on the balance?
That's right.
Okay.
Yeah.
So what does that translate on a
75
million then? What is that?
It's about 7.5% of
75
the
grand.
Yeah. And then we always ask for at least a 1.5% in closing costs, right? So your property transfer taxes, your legal fees and all that sort of stuff. So technically, if your client's buying a home for $1 million, you need about close to 10%, about 9%.
80 grand.
Yeah. Okay, out of which they'll use 7.5 for down payment, and then they'll need to show X amount, which is for closing costs. All right. Let's talk about some of the unique products that we have. Okay, so the most unique product that we have is the Purchase Plus Improvement. I think Chad, you've already talked about
I
this.
did do, yeah.
Right?
Yeah.
So I'm just going to rush through that really quick, right? So the Purchase Plus Improvement is a program that allows your client to add the cost of a renovation to the purchase price of a property, right? So if your client's buying a place for $400,000, and we know that the average age is about 20 years on a property, and they're looking at getting a new kitchen done, and the cost is going to be $20,000, they can actually add the cost of that renovation to that $400,000 purchase price, and we would finance it as a purchase price of $420,000. And then they need to find the 5% of the 420 rather than 400, and just take it on from that.
Who calculates the cost of renovation?
So if your client is doing a renovation up to $40,000 or 20% of the purchase price,
Yeah.
then the cost of the renovation is pretty simple to calculate. Your client can actually just go to like a Home Depot and get a quotation and say this is what it's going to cost me to get a new kitchen and new tiles and new floor and this kind of stuff, and we would approve it. Okay. If the cost of the renovation is going to be over that $40,000, then it becomes more like a draw mortgage, like a construction mortgage, where there's appraisals involved and all sorts of valuations involved. And then you probably need a proper contractor to come and give you a quotation and all that sort of stuff.
Okay.
Right. So stick under that $40,000 mark,
Okay.
right?
So okay, or is it 10%?
10% or capped at 40.
Or 40, okay,
Yeah.
got it.
Okay?
Anything over $1 million,
Yeah,
you guys aren't insuring?
nobody insures.
So if somebody has the 20% down, it's still much harder to get a mortgage if it's uninsured.
Well,
You don't need
if-
insurance.
If you do,
20%
You
down.
still need to get a mortgage though, so it's harder
Yeah.
because it's not insured. So you have more down, but they don't want to take a risk. The banks, even though you're
But
giving
what
more
happens with
money.
that
See what I'm
is
saying?
there's a lot of
Is that-
lenders that
is that
have
right,
Jack can tell you guys about this, right? So if you have a client who's got 20% of $1 million, let's just say the property is 1.1 million, it's not an insurable property. The client has 20% down. Chad has options of lenders that have different rules to qualify the client, right? So not every lender just looks at your T4. There's some lenders that will do things differently and look at other means of income. So that's kind of like where Chad fits in,
Okay.
and I stay away from that space.
Just a quick note on that then. So if you have a client who wants to list it at $1,050,000,
Yeah.
would you say, hey, it's probably better to list it at $999 because you're gonna get more people that qualify for it?
Not necessarily. In terms of qualification, it's not harder to qualify necessarily for an uninsured mortgage, or there's more options out there probably for uninsured options, because as he's saying, there's more lenders with more specific programs. It's just a matter of that down payment is what comes into factor, and is that going to limit you, having to have someone come up with that 20%?
Okay.
Cool. Questions? Did I answer that question? I know what you're saying though.
Yeah, because I just
Generate
went through
some
the same
profit,
thing
right?
and I'm thinking it's harder if you're over $1 million, even
Yeah,
if you have.
but
Yeah,
don't forget.
Only
that-
marginally
Yeah.
though, I mean, it's so close.
Only certain lenders apparently will. There's like 3 that will do that for certain people, especially if you're self-stated income, right? So that's a whole different ball of wax, I think, there.
Yeah, but there's tons of stated income programs out there. So
Yeah.
there's a lot of lenders that will accept a stated income. Seeing that BC has probably more than 50% of people that live here are self-employed, right?
Work ban for the government employees.
Yeah.
So,
Yeah.
If you're self-employed, I guess you need a 2-year average.
Typically, yeah, there is programs where you can get around that, but typically most lenders, if you're going with, your kind of Schedule A banks, your TDs, Scotias, that type of thing, they'd like to see 2-year average.
So that's kind of like what the purchase plus improvement is. There's no limit as to what you can finance in that improvement, but it's generally just improvements, right? You can't finance stuff like appliances and a new TV. We've had that question, all right?
And if the person's doing the work themselves, they can't bill for their personal labor.
That's
which
right.
I've seen happen
That's right.
before.
That's right. Yeah, that's right. But in this region, in this area, what we've seen a lot on the purchase plus improvement is people buying single-family homes, if they can find one under $1 million, with an unfinished basement, and then finishing that suite for rental income. No, you cannot use that rental income.
Yeah.
To qualify for that.
Yeah.
Okay, so that's a big one in the Fraser Valley. Not in this area so much, but the further out you go towards Aldergrove and Chilliwack.
You
That's big.
can't use that income because it wasn't there.
Unfinished basement
It's
homes.
not
It's
there
not
at the
that.
time of the mortgage.
We've had situations where we've said yes on that income, and then the client's done the reno and said, you know what, actually, I like this place. Work out of this place. This is gonna be my office now, right? So all of a sudden, those ratios don't work out anymore, right? So that file is not compliant.
And if the suite was there already, then it'd have to be registered.
Well.
No, so there's a difference between an illegal suite and then something that's unauthorized, okay? So if it's an unauthorized suite, we're okay with the
Yeah.
income. If it's illegal, then I don't think anybody's okay with that, right? So just make sure when you're writing up your MLS listings, you're not saying illegal, you're saying unauthorized. Alright?
What's the line between those two? Illegal is what?
I think illegal is kind of like considered that it was done, I mean unauthorized is the same thing, but I guess it's just the way it's worded, right? Illegal is actually saying that this is illegal, there's no permits, there's no this, there's no that. Unauthorized is saying, we don't know if there is, right?
Yeah, and a lot of the unauthorized suites
Yeah.
in municipalities are recognized by the municipality as
Yeah.
being there. the taxes are increased,
Yeah,
but it's still considered an unauthorized, even though they're paying extra taxes.
Exactly.
The municipality knows there's a secondary living
Exactly.
So
space
the
there.
crackdown is all but halted?
oh yeah.
Surrey's always been like that though. You can go online there,
There's
just
a
register
card.
it. You can register anything today.
Suites like that.
Online.
Then that's
So you're
different.
good, yeah.
Yeah.
Yeah, and then they just increase your taxes accordingly.
Yeah.
The township in Langley though, no. They don't want that. Anything unauthorized, they'll be on you.
Well, that's what I was saying. For a while there, they were really cracking down. Is it still?
I think they're still doing
I
it.
haven't heard anything.
Interesting.
Well, everybody's gotten kind of rabbit hole, right? They've kind of, oh, that's other, it's not a kitchen, it's other, or whatever it is.
Well,
and they'll put it in the
Yeah.
They're in the
comments
listings. If they were perusing the listings before, you can see.
That's right.
in Craigslist.
Exactly.
Yes.
So that's kind of like what a purchase price improvement looks like. It's great for you guys to know when you're taking your clients out that there's a way that you can add the cost of this reno to your mortgage rather than trying to qualify for a line of credit after the fact, right? It's a lot difficult when your ratio is already maxed because of this mortgage that you're taking on. Very, very difficult for you to then get a $40,000 line of credit to do renos. Okay, so
And that's most likely gonna be your lowest priced option.
exactly, it's gonna be a lowest price option, it's gonna be in the thing, you've amortized it over 25 years, you're actually saving money, right? The other unique program that we have, well, it's not a unique program, but one of the bigger programs that we have is the New to Canada. Okay, so the New to Canada basically means anybody who's come to Canada in the last 60 months, or the last 5 years, is considered New to Canada. We're pretty flexible when it comes to their income and their credit. Okay, so they still need to be employed in Canada for at least 3 months, but we're okay with like annualizing that income. We don't look for like a 2-year average or anything like that. We're okay with thin credit, so if they have like 1 or 2 trade lines on their credit bureau, but they can give us like an alternate way of verifying their credit, like a bank statement that shows the rent going out for the last 6 months or something like that. We're okay with that. Okay, so we're pretty flexible with the newcomers. They make a huge part of our business. I think 1 in 5 files that we do are.
Well, for sure, because it's easier for them.
It is,
And
yeah.
it's gotta piss people off.
Exactly.
Why would,
Yeah.
you go so tough on Canadian citizens?
Exactly,
they
and
make
then that's
it
why the
easy
banks
for
have all
everybody
these
else.
offers, right? New to Canada, come over, we'll give you a credit card for free. They want to get these guys, right? Because these guys are going to be lifers.
So a new, what's the term they use, immigrant?
Yeah.
Yeah, a new immigrant is less than how long in the
5 years.
country? Less than 5 years, wow.
And has never owned a property in Canada. Okay, so a lot of the times, the greatest question I get over here is, oh, I have a client who's been a student here for like 6 years, and he just became a permanent resident last year. Does he still qualify? Yes, he does. So he's considered a new immigrant from when he became a permanent resident.
Oh, okay.
Because that's a great.
So what if he has his own
good-
business?
It gets a little bit sticky there, right? That comes into like the self-employed kind of. The New to Canada is kind of like for a very like a clean file. Guy's employed, buying a house, got 5%, credit's a little bit thin. Yeah, no problem. We'll give you the money. Somebody who's self-employed, it's a little bit sticky because for self-employed we need a bit of a history of what that income looks like, right? We go with the past history. We don't go with projected income. Okay, so it does get a little bit sticky.
Okay. And 5% up to,
It's the same rules, 5% for the first 500 and 10% for the balance. So if your client's buying a property, say for 600,000, you would need to find 5% for the first 500,000 and then 10% on the 100,000 on the difference. Yeah.
Sorry,
1.5% for closing.
Yeah.
you're on a work permit?
Yeah.
When do you start counting in 5 years?
Work permit's fine, we'll do
When the
that.
work permit,
Yeah.
or when, okay.
When it was
not
issued.
they become,
No.
yeah, okay.
Yeah. So if you have clients on a work permit, they can actually buy in the high ratio space.
But then you gotta be careful on foreign buyer tax.
Right.
I think it's exempt on the.
Oh, are they?
I think so. I don't know, do you have any
Unless they have a
that?
paper.
I'd have to double check on
Yeah,
that.
I think if they're on a work permit, they're exempt.
Is that right?
I
Then you
believe
can
what
get some
permit
back.
is, but
Yeah.
Visitors aren't, though, right?
The visitors
They're
are not,
just-
yeah. I think work permits are, because the intent is that they will become permanent residents.
Because if you get your PR within a certain time, you'll get some of that back, right?
Yeah.
But,
Yeah, but I can double check on that for you. I've got a feeling there might be something. So that's kind of like what that is. But the kicker to this program is that 5% needs to be the client's own sources. So the client can't get a gift from his next door neighbor and say, I'll buy a house, right? He needs to have that 5%
Okay, no
from his
gift.
own money. Okay? If the down payment is going to be more than 5%, then the difference above that 5% can be gift.
Oh, yeah.
Okay?
So just get the 5% 90 days before.
Yeah. Sure.
Get it and hold tight.
Just sit there. That's where you guys start prepping your clients, right?
Exactly.
Let me ask you guys a question before I go to the next program here. So, how many high ratio mortgages do you think your client can have? So if you have a client wants to buy like 10 houses and he wants to put 5% down for each house, can you do that?
Just one?
As long as
Probably.
it services the debt.
I'm hearing lots of
A little
questions
bit
here.
more, a little bit more.
Lots of answers.
I say yes.
You say yes?
Unlimited,
Wow.
as long as he qualifies.
Yeah, that's a great way to look at it, right? So with CMHC, you can only have one insured mortgage. Okay, so at any one time, that's your principal residence. You can't insure any other property other than your principal residence. Okay? With Genworth, you can insure up to 4. Okay, as long as they're owner occupied.
4 owner occupied.
Yeah,
I was waiting for that.
yeah,
Solid riddles.
I was waiting for that.
yeah. 3 months of the year?
I'm gonna hear 1 week at a time.
Exactly. So one's
That
going to be a
Genworth
principal residence,
company,
right?
I love that company.
So the first one's your principal residence. The second one's your vacation home in Kelowna, right? The third one is a second home because you work in Chilliwack once a week every month, and you want a second home there, right? The third one could be you're buying a property for your parents who are elderly and they can't qualify conventionally, so I'm buying kind of like a family home, right? Buying a place for my kid who's going to SFU and I needing to have a condo close to there, so that's a family home. So any combination of that makes it 4.
So it has to be family occupied or
Yes.
not rental properties?
You can, but then with a rental, to insure a rental, you need more than 20% down payment. Then you're better off just doing it conventionally, right? But sometimes what happens is you might, your situation might be so unique that you do have the 20%, but no lender is willing to take that risk of lending you that money directly unless it's insured by insurance. So a lot of times you'll see, not a lot of the times, but sometimes you'll see some clients who do have 35% down payment, the file still needs to be insured.
So if you did one for your son or daughter, could they be on title? Or
Yeah, as long as they're, yeah, they can.
Okay.
Yeah.
That would probably help it.
Yeah. Good. Great company, I like it.
There you go. Right.
In that situation, would the company want a guarantee from the parents?
So basically, as long as the principal applicant is kind of like on title,
Yeah.
that's fine. So with a guarantor, they would need to be on title for us to use their income, right? So it's one of those. So that takes me to my other program, which is the vacation secondary loan program. So there you go. So that's why I kind of like threw that in there before I talk about that program. So if you do have clients who are looking at either downsizing or buying a secondary property in on the island somewhere or Kelowna somewhere, there is an option to do that with less than 20%. Okay, a lot of the times what happens is, as your clients are retiring, they have money stuck in other assets like RSPs or stuff like that, and you don't want them to start liquidating that, right? Sometimes they're earning more money in whatever they're invested in than what they would have paid in the premium. So there is an option for them to go high ratio and pay a little bit of a premium and get that vacation or secondary loan secured.
Sorry, can I go back to as a new immigrant? I
Sure.
just have a quick question. So sometimes there are students that come here and they go to school here and then
Yeah.
they get a work permit.
Yeah.
So I guess they won't count that as a student. As soon as they get their work permit, that's when it would start.
So their student years are kind of like whatever. So as soon as they get their work permit,
Right.
that's kind of like when their 5-year mark starts.
Okay.
help. And then we have a business for self program. This is a great program, guys. This is something that you guys should be utilizing for your self-employed clients. It's a stated income program, okay? So we allow your self-employed clients to buy a property with 10% down and stated income to qualify, okay? Now, not every lender out there supports this program, but Chad will probably better know which lenders to send a fund like this to, okay? It's not a very black and white program. Every file is looked at its own merits, right? So if you do have a client, we're gonna like look through that file properly and just go through everything and make sure that that stated income is reasonable to what a client should be making, right?
So by stated, you're saying what, no tax returns for the last?
So no, you need to have a tax return, but your personal NOA is showing, say, $50,000. You've been self-employed in a business, and you're a tradesman, so you're a plumber, self-employed, small-time company. You've got a lot of cash element coming into your business, which you're not declaring on your taxes. Chad needs to, state an income of $80,000 so that the file approves. We're okay with that.
Would there have to be a minimum period in the business?
Yeah, so the minimum period is 2 years, but it's not set in stone, right? So what we have situations where, you'll have a client who's worked in an industry for a long time on T4, and then decides to go self-employed in that same industry, and only has like 1 year of self-employed taxes. We would consider something like that as well.
Makes sense.
But it somehow sounds like turning a blind eye to the small businesses that don't state the actual income to the government.
Yeah.
Essentially.
Yeah, essentially.
There's a lot of those, but
Yeah.
I mean,
Like
Yeah,
Revenue Canada would love to get a hold of those files.
Yeah. No, it's not tax evasion, right? It's like a lot of companies.
It is.
If you're a self-employed, like a lot of companies, if you're a limited company and you have X amount of revenues in your business, but you're keeping a lot of those revenues in the business and only drawing a small percentage as a personal income. A lot of the times that income that you have left in your business is left, it doesn't go anywhere, right? But technically, you could have drawn that money and, have $100,000 income, no
I
problem.
guess I'm thinking more of the restaurants, the
Well,
modern
that, yes,
restaurants that are
yes,
claiming
yeah,
really
that-
show
yeah,
up as
exactly.
income.
But that's where we're
That's
pretty.
tax evasion, and the rest of us are paying our damn taxes.
Exactly, right? But that's kind of like where we draw the line as well, right? We don't allow you to like state an income of 300% or anything like that, as long as it's reasonable. Reasonable is kind of like the key word here, right? So if you're showing a NOA income of 50,000, what's reasonable for the type of business that you have? It might be another 10%, another 15%, right? That you're undeclaring or whatever it is, because you have an element of cash or you have an element of expenses that you can write off in your business, that kind of stuff. All right? And this kind of program works really well with trades. So there's that option too. All right? Any questions on that, guys? Make sense? Let's move on. So I've talked about all these programs. I'm just going to skip through this here. I'm going to show you quickly this little guy over here, which kind of shows you what the difference on a $400,000 purchase would look like with a $30,000 improvement if you were to just get the $400,000 and get a $30,000 line of credit versus getting the $30,000 into your $400,000 purchase price. So on a purchase price of $400,000, your down payment of 5% would be $20,000. Your base mortgage would be $380,000. The premium you would pay would be $15,200, which would bring your mortgage up to $395,200. Okay. If you added that $30,000 into the purchase price, your new purchase price becomes $430,000. Your down payment goes up a little bit by about $1,500 to $21,500. Your base mortgage becomes $408,000. Your premium goes up a little bit to $16,000. Your new mortgage would be $424,000. Okay. What that actually means is that, based on the first scenario, using a $30,000 line of credit with your $400,000 purchase, let's just say the interest rates was at 4.84% right now, which they were, I think, when this thing was done. And your payment would look like $22.65. Your $30,000 line of credit at about a 7% interest rate. That's a pretty conservative interest rate, too, right? I think line of credits right now unsecured are probably around about 10 to 12%, something like that, right? Your monthly payment on that interest only would be about $307. Your total monthly payment would be $25.72, and the interest you pay over 5 years would be about $98,000. And by doing the purchase plus improvement and adding the $30,000 into your mortgage, your now payment on the whole thing goes up a little bit by a couple $100 to $24.32, but you've eliminated your line of credit payment, which means your client's actually saving about $140 a month, right? And the interest that he's paying over the 5 years has gone down, so he's got a good cost saving in a year by just bumping up the down payment a little bit. So it's something that makes sense for a lot of clients. So all the products that we have can be found at homeownership.ca. So this is a very client-friendly website. Okay, so you can actually direct your clients if they're asking you questions about high ratio. I would direct them to Chad, right? But if you just want to like maybe show them something really fast, see changes that are coming up, all that kind of stuff. The beauty about this is if you've registered for one of these webinars and you can't make it, they actually send you a link, so you can actually listen to it in your own time as well. Okay, so good stuff for you guys to lock onto. The other thing we have is we have a lot of promotional stuff that you can actually download from our website. So if you go to genworth.ca, there is another website that's linked to that. It's called My Marketing Source. It's under the Realtor tab. If you create an account on that, there's a lot of client-friendly material that you guys can download from there and actually personalize it with your own picture and information. So if you're meeting with a first-time home buyer and you just want to give them like a tip sheet on what they need to know about purchasing a home for the first time, you can actually do that and personalize it with your own information, right? 10 great reasons for using a realtor. So there's some great info for you guys to kind of push out to your clients and drip on them once in a while. It's all free.
Nice.
Okay?
Thanks, Ian.
Can
You only got it.
Absolutely. And then there's some quarterly and monthly publications that we do as well. If you register on Genworth.ca, they will send these publications to your inbox. There's a lot of good stuff, like the first time home buyer studies, so all these graphs and stuff that I was talking about, like this is what the average age kind of thing looks like. So a lot of that information gets automatically pushed out to you guys, so you guys know what your clients look like in a certain area. Alright? And then don't forget to follow us on social media. So we have an active Twitter, LinkedIn, and Facebook presence. We also have a YouTube presence where we do a lot of these short videos. So I'm hoping that video is not going to end up on YouTube. It might.
That was the intention, I think. Seriously though, would you rather it not?
It's fine.
Because you kind of need.
So make sure you guys follow us on our social media channels, and there's a lot of good information that we post on there, whatever, and you guys can share that kind of stuff for your clients to see as well, right? Do you guys have a website? Do you guys have individual websites? Mm-hmm. Do you guys put calculators on your websites? Mm-hmm. Right? So you can actually download calculators from the Genworth website too, and then put those on your website. So your clients can go in there and see what the premium would look like on a certain purchase, what their minimum down payment is that they need for a certain purchase, what their monthly payment would look like at a certain rate. It's a lot of useful calculators for you guys to download and put on there. Sorry, take your time.
I'll make sure to send out all these links and sites.
I'll send all these
to
links
you guys
to you.
after, yeah.
I was just thinking how many have been in here and said they were gonna send us their presentation. We can never get it.
So the presentation I can't send, but I can send you the links.
Yeah.
Or
And I'll make sure you get it.
Or go to genworth.ca, it's probably all there.
Yeah, exactly.
That's gonna be the link, Genworth.ca.
Done.
All right, and last but not least, guys, we have a pretty handy app. Everybody uses a cell phone nowadays, right? If you go to genworthmobile.ca, all the information that I gave you is actually accessible to you on your phone, right? So you can actually set it as an app on your front screen, and you have access to all the information that you need right on at your fingertips. All right.
Excellent.
Homeownership.ca, we talked a little bit about this. It's a very client-friendly website that you can direct your clients to. But obviously, you want to, for the right advice, you want to direct them to chat, right? Because there's a lot of stuff on there that gets pretty confusing sometimes, especially for the first-time home buyer. They're probably the hardest demographic to work with, right?
Hardest.
Some
education required, of course, yeah.
So definitely, yeah. But if you guys need any information, it's right there for you guys.
Which demographic was that?
The first timers.
Sorry.
That said the elderly.
You're gonna have your own seminar pretty soon.
The other thing I want to touch on is the energy efficient rebate for home buyers. So we are an insurance company. We make our money by charging a premium, right? But if your client is buying a home that's energy efficient and it's got the certifications required, we actually refund up to 25% of that premium that they paid to Genworth. Okay, so that's something to keep in mind.
Does that have to be made out of him?
Exactly, right? Yes.
Why not?
Yeah. The beauty about this program is it also works with the Purchase Plus improvement. So if your client is buying a place and is adding the cost of a renovation to that purchase and is doing energy efficient improvements to that property, we will still refund up to 25% of that premium
Of the renovation.
of the renovation.
So for the energy efficient, are those homes, does that only go back so many years when they started doing it? Is that like
I
last
think as
5
long as it
years?
has the particular certification required
Okay.
to say that it's energy efficient
Yeah,
home.
yeah.
But don't forget, not all elements might not be energy efficient. Like it might have like an energy efficient
Furnace.
furnace.
It's gonna be tough to qualify.
Yeah,
Yeah.
but like all the newer homes, I think a lot of them are actually energy efficient.
Yeah.
So I think a lot of the developers probably don't apply for that certification because of the cost. But if the property does have that certification, we will refund that to you. And we do it pretty fast, within like 25 days.
Okay. Yeah, I think larger developers like say
Yeah.
Morningstar and stuff like that.
Yeah, they probably have it,
Yeah.
especially out here in Langley. Do you guys work out of like Willoughby, any listings out there?
Yeah,
I think a lot of those probably are energy efficient,
yeah, yeah.
right? Last but not least, sorry I said that twice already, right? I'm going to talk about homeowner assistance program here. We call it the HOPE program. So this is a very, very unique program to Genworth, right? So, you know, our aim at Genworth is to keep families in their homes, right? Is kind of like get them there and then keep them there when, you know, things go sideways a little bit. Because things do go sideways from time to time. You know, if your client is having financial difficulties and that mortgage that he has is actually insured by Genworth, a lot of the times we will try and work around and try and keep that client in his home, right? Because at the end of the day, we realize that you know, it could be like a short-term thing, like maybe short-term disability or something like that. What we do is we actually sit down with the client, we sit down with the lender, and we try and figure out a way to keep that client in his home. So what that looks like is very different for every client, but we've done things that are totally outside of the box, right? So, you know, we had a client who got injured at work and couldn't work for about 4 months. His mortgage went behind like 3 months. The bank had already started foreclosing process. We then came to the table. I think it was $10,000. We paid the bank $10,000 as an interest-free loan to the client, right? To bring his mortgage up to date so that he can stay in his property. Went back to work, started paying that money back, that kind of stuff. We've done promissory notes where we've given clients like $12,000 and we've said, hey, we'll let a fifth of it go for every year that you keep your mortgage up to date, right? In situations where there's a death in the family and say the main breadwinner passes away and the other client, the remaining spouse, needs to sell that property, but there's a negative equity situation and all sorts of things going on, We even pay for legal fees and realtor fees and stuff like that. Alright, so, again, go to our website, homeownerassistance.ca, it's all on genworth.ca, under that realtor tab, you'll get tabs for all of these. And have a look at some videos that are live testimonials from some of these clients, they're pretty cool. The biggest one we did recently was Fort McMurray with the fires.
Oh,
So a
yeah,
lot of
yeah.
people lost their homes, and a lot of people did not know that they had something like this available to them, so we actually went out looking for them and basically said to them, hey, it's a Genworth insured mortgage, there's a way to work this around. Yeah. So we did some good things too.
Good.
All right?
We never doubted that. We never doubted.
There you go.
Hey, question.
Yes.
So, what do you do with part-time income earners? Say it's like would you finance someone like that? Say it's like a nurse who's making over $100,000 a year, but doesn't want to go full-time and just does part-time?
Mostly it's a 2-year average, or something like that.
Okay.
Yeah. So, yeah, but it depends on the lender, but I think most lenders are pretty standard with the way they look at that. So seasonal income, part-time income, anything that's not a salary,
Yes.
right,
Yeah.
would be looked at as a 2-year average. So, you know, self-employed commission income would be looked at as a 2-year average,
Yeah.
right? Yeah.
That's fair.
Yeah.
Excellent, thanks so
Any other
much.
questions, guys?
So take your card, but contact Chad.
Yes.
Thank you.
Thanks, guys. You can contact me, guys. I'm just joking. You can contact me, but Chad's kind of like your main point of contact when it comes to anything lending related. But if there's anything specific you need to know about high ratio, or
Yeah.
you know you want to find out about a certain
Yeah.
property, whether it's insurable or not, or you just want to have a buy me a coffee or something, hey, call me.
We won't go straight from Chad to Ian. Forget about it.
Yeah.
Hey, who is this Ian guy?
Ian's a good guy.
So